Everyone, we appreciate you joining us for today's Trading Pub event. We've got a great strategy summit, some excellent speakers lined up. You guys have seen this before. You'll probably see it again. Just a quick risk disclaimer. The guys that are in the room today are just going to be sharing with you some basic education. They're not making any kind of trading recommendations. You guys have to decide for yourself whether or not the strategies they discuss are suitable. Just to tell you a little bit about the Trading Pub, then we'll turn it to the first speaker. The mission of the Trading Pub is to provide a place for our patrons where they can hang out with some of the top traders in the industry. The pub is the place to receive quality education, all while interacting with traders and investors who are just like you. You know, throughout the Trading Pub, we want you guys to learn from top traders in the industry. We want you to enjoy your time here. You know, everything's better amongst friends, so let's all have a good time. And then we also try to put a focus on giving back to others, and 10% of any revenues generated through Trading Pub are given to inner city development, charities that specialize in that and workforce development. We are going to be recording today's event. That's a question we get asked often, is where can I find the recording? If you go to our website, which is tradingpub.com, and then click on free education at the top. So again, click on free education at the top of the screen. That's where we post all of our recordings. We'll also send it out on Twitter. So if you're in the Twitter sphere, you can follow us here. And on Facebook, we'll post most of them there, as well as some interesting commentary at facebook.com/tradingpub, so you can like us there. We're approaching 30,000 people there, so that would be cool if you want to help us reach that. Rules of the road, if you're going to be here, all we ask of you guys is just to be cool. You know, you don't want to be that guy on the left. If for some reason one of the speakers is talking about that is that's not right for you or doesn't really interest you, don't, you know, be rude in the room. Just simply log out and enjoy the rest of your day. If you're going to be here, you want to be the guy on the right, be cool, and enjoy your time. We've got some excellent speakers lined up. We'll get started with James Edward, who's going to talk about complete currency trading. Colin Keena talk about binary options, followed by Steve Patterson on the markets are rigged. Brad Powell will discuss knowing yourself as a trader. Giles will talk about trading support and resistance on any chart, and then Alan Morrison on indicators that signal entry with no uncertainty. So each speaker is going to have 30 minutes to discuss their method and what.
Okay, thank you, Morgan. I'll just start sharing. Just make sure this is working, and hopefully you can hear me okay and can see my screen. You can. I'll just wait for someone to let me know that they can actually see that screen and can hear me. Yep, that's good. Okay, well, hello everyone, and thank you for joining us. I'll extend the thank you that Morgan just said. I appreciate you taking some time out of your busy schedules to listen to us all today. So I will certainly do my best over the next 30 minutes to make this worth your while, present something that I hope you find valuable and you'll be able to use to improve your trading in 2013. So for those of you who don't know me, I am, if you haven't heard of me before and don't know what I do, I am a currency trader. I specialize exclusively in the Forex market. So that is what I'm going to be concentrating on and talking about today. I'll very quickly tell you a little bit about my background and how I got to where I am, just so you can understand why I focus my trading on Forex as opposed to any other market. I started my adult life as a Royal Marine Commando in the UK. I spent 10 years serving all over the world, from the jungles of West Africa to the frozen north of the Arctic, and then inevitably Afghanistan and Iraq after September the 11th. And when I finally left the Marines, unsurprisingly, I didn't have many transferable skills for working in a typical 9-to-5 job. So I naturally got drawn into close protection and bodyguarding. Fortunately for me, rich people like to have ex-military with my skills and experience looking after them. So I was very lucky to be able to work for some very famous and well-known people. That is me in the white shirt with Elton John when I was his bodyguard. But I also looked after royalty, politicians, and some of the richest and most successful business people in the world. And it was whilst I was doing this job that I had a chance encounter with John Henry. Now, John Henry is a foreign exchange and futures trader. He's a hedge fund manager. And he also owns Boston Red Sox and Liverpool Football Club. And he's worth just over $1.1 billion himself personally. Now, he came on board a yacht that I was on to have dinner and drinks as the guest of the man that I was working for, the person that I was protecting. So that evening, I spent several hours in the same room as him, listening to his conversations with my boss in a very informal and relaxed environment. And as I listened to him, and I heard him talk about what he did and how he earned his money, there was something that really struck a chord with me, something that made me think, that's what I want to do. Now, it was probably the fact that he was a billionaire, but he achieved that from just trading the markets. He didn't own a massive corporation or need to employ thousands of workers or any of that traditional empire building. What he did appeared to be much more achievable for me to do. So that was me hooked on the idea that trading was the vehicle that I was going to use to make myself rich and fast. Now, if only it was that easy. I spent the next 2 years going around in circles, studying different theories, reading lots of books, and of course jumping from one system to another, looking for that elusive holy grail. And as if wasting my time wasn't good enough, just for good measure, I lost literally tens of thousands of dollars as well in bad trading, all my own fault. The only thing I really achieved in that 2 years was finding all the ways that didn't work for trading. I was very skilled at uncovering losing strategies, but at least I could tick them off and eliminate them from my list. But I never actually found what did work. But I got a phenomenal break. At the time, I was still bodyguarding, and I was working for a billionaire who I got on with very, very well. We're actually very good friends now. So he saw me looking at charts on my laptop one day, and I explained what I was trying to do. And the next thing I know, he had called a friend of his and arranged a meeting for me with the head foreign exchange trader at an international bank based in London. This was the top currency trader at that bank, so genuinely an insider. Now, this bank trader was basically asked by my boss as a favor they could teach me to trade. And it does just go to show that it's not always what you know, but who you know that often makes a difference in life. This was the big break for me. So over the next 12 months, I was informally mentored, if that's the right word to use, in how to trade Forex, the way the true professionals do it, the banks. Now, a year later, I quit my job. I've been trading full-time ever since, and I now run my own fund and manage other people's money for them. So it was that sequence of unusual circumstances of bodyguarding the rich and famous and then meeting John Henry, a currency trader and futures trader, and then being introduced to my own Forex mentor that has resulted in me specializing as a currency trader exclusively. And I have to tell you that what I was shown by that bank trader over the year of mentoring really opened my eyes to the reality of the market that I've never seen, never heard of, never understood before that time. Now, I hate to use the word secret because I don't think there are any secrets in trading. But what I was taught was certainly something that most people are unaware of. What I plan to do now is pass on that knowledge to you. So I'm going to show you a small sample of what I've learned from the professionals on the inside and what I've been exploiting for my own trading over the last 6 years. So I'm going to show you what really causes intraday trends on currency pairs, and then I'll show you how to identify where and when those trends are most likely to occur so you can maximize your own winning potential from those opportunities. Now, the first thing to understand is how prices move in the Forex market, because it's actually different to most other markets. With stocks, for instance, the prices you see are the last price that a transaction was made, the last price two people actually bought and sold to each other. So for the price to move or change, someone has to buy or sell. There has to be an actual transaction. But in Forex, it's not like that, because the Forex market is an auction market. Now, the prices you see are the prices that someone is willing to buy or sell at. So think of a normal auction where you may be trying to buy a painting. The price starts low and it gradually goes up higher and higher as people bid more and more. So the price is changing and rising constantly, even though no one has actually bought anything and the painting hasn't been sold. And that's what it's like in Forex. So the prices can actually move without any buying or selling happening whatsoever. All it takes is for people to alter their bids and offers. And actually, that's what happens when you see the spikes and whipsaws around news releases. It's not panic buying and selling, it's simply dealers changing and altering their bids and offers. Now, when you understand the micro-mechanics of an auction market, you can determine which direction the price is most likely to move, because prices in Forex are more likely to move in one direction rather than the other. And when you can identify that, you have a real edge that you can exploit for huge profits. So let's suppose that you and I are both speculators. We're both trading with the same broker dealer, and we are both looking at the same currency pair. I want to buy 100,000 and you want to sell 100,000. So we both hit our order buttons. Most people think that we would be matched against each other, so we would buy and sell from each other. But that's not true. It's not even possible. If I submit a market buy order and you submit a market sell order, it is impossible for us to trade with each other as retail traders. Market orders can only be matched with limit orders. And the limit orders are the bids and the offers that you see as the quoted prices in your platform. That is the price you see. So limit orders provide liquidity, market orders consume that liquidity. We know that. So my market buy order consumes the liquidity in the offer price, and your market sell order consumes the liquidity in the bid price. So if we both submitted the same size order at the same time, the spread would widen because we consumed and removed the liquidity for the narrowest bid and offer in the market. Now take a look at this and you'll see that price is more likely to move in the direction of least liquidity. And this is what professional Forex traders exploit for intraday trading. This is what gives us a real edge. Let's assume that this is the depth of bids and offers behind the market. So someone is bidding 500,000 at this price and another 500,000 at this price and so on down. On the offer side, someone is only offering 10,000 at this price and another 10,000 at this price, and so on. Now, this is an exaggerated example, I know that, but it will prove the point very, very clearly. Imagine you and I both come in with our market orders, so you sell 100,000 and I buy the same amount, 100,000. Your sell order is absorbed by this 500,000 bid here. You only consume 100,000, so 1/5 of the total amount available, but there's still 400,000 available there, so the price doesn't actually move, and it won't move until someone comes in and consumes the remaining 400,000. So the high level of liquidity to the downside prevented the price changing even after you sold. So there was a transaction, but the price never changed. Your order was 5 times smaller than the liquidity available, so your order was simply absorbed by that liquidity. However, my buy order was 10 times bigger than the liquidity on offer. So my order consumed this 10,000 offer here, and the 10,000 offer above it, and above that, and so on. So my order, which remember was exactly the same size as yours, caused the price to move up 10 levels because there wasn't enough liquidity to absorb it. My order consumed all the liquidity that was on offer at each higher level. So 2 equal size orders, yet the price didn't move at all after yours because of the increased liquidity on your side, but it moved up 10 levels after mine because of the reduced liquidity to the upside. So that's where price will move. If 2 equal size orders are placed in the market, the price is more likely to move in the direction of least liquidity. Now that is not theory or conjecture, it is mathematical fact. But it gets better because when the price moves in the direction of least liquidity, the dealers can begin to suffer losses. Now remember, the dealer profits from the spread, yes? So in order to make that profit, they have to buy and sell quickly before the price changes. Everything the dealer is geared up to do is buy and sell almost simultaneously so they can profit the spread. And if they don't manage to do that fast enough, they can get caught out on the wrong side of a trade. So, contrary to popular belief, dealers do have trading risks just like we do as speculators. So as the price starts moving up quickly, as in the example that I just gave you where they sold to me, the dealer that traded with me is now on the wrong side of the market and suffering a loss. So they try to reduce any further risk by reducing the amount they're offering to sell to anyone else after me. They sold to me, and to balance their books, they need to buy the same quantity from someone else at a better price. So they don't want to keep selling into a rising market because that would increase their loss. They'd be adding to an already losing trade. So to limit the amount they have to sell, they reduce their volume of their offers, which in turn reduces the liquidity to the upside even more, and therefore the prices are even more likely to keep going up. It is a self-perpetuating force that feeds on itself and gathers more and more momentum. That is what causes momentum. That is precisely why intraday trends happen. That is the mechanics behind a trend. It is an imbalance between supply and demand, and supply and demand has got nothing to do with buying and selling the way that most people think of it. In an upward trend, it doesn't happen because there are more and more people like you and I trying to buy compared to people like you and I trying to sell. There could be a perfectly balanced number of us split between buying and selling, exactly like in the example I just gave you. The trend occurs because there is more demand for liquidity on one side than there is actual liquidity being supplied. So there can be an equal number of buyers and sellers, people like you and I on both sides of the market. But the demand from me as the buyer is greater than the supply of liquidity on my side of the market. That's what causes a trend. And when that happens, the price will keep going for longer and further in the same direction. This is what we exploit as intraday currency traders. When the situation I've just explained occurs, and it does occur all the time, the price of that particular currency pair is more likely to continue in one direction. It's all about that imbalance between demand for and supply of liquidity. And when that imbalance exists, the price is more likely to continue in one set direction. So the question now is, how can you identify those imbalances between supply and demand so that you know which direction the price is more likely to move in, so that you can get into the right trade and profit from that trend? Well, we have a huge advantage in Forex that other markets simply don't have. Unfortunately, it is an advantage that most people are completely unaware of, and one that they just totally ignore. You really have to understand the nature of the Forex market to really appreciate where the advantage lies. Most people look at a currency pair chart and they see a market. This chart of the euro-US dollar looks exactly the same as this chart of Google shares. They're both displaying price bars with an open, high, low, and close. And because they look the same, people assume they are the same. But the truth is, the similarity is only superficial. If you were a stock trader, you would look at the chart of the stock you were trading. If you were a commodities trader, you would look at the chart of the commodity you were trading. If you were a currency trader, you'd look at what? A currency pair chart? Well, that's what most people do. But what you should be looking at is the individual currencies, not pairs. If you're a currency trader, you should look at currencies, not pairs. The clue is in our name, we're currency traders. Now, George Soros is probably the most famous currency trader of all time. He's known as the man who broke the Bank of England when he made $1 billion profit in one day. He did that by trading the British pound. He saw weakness in the pound and he sold it across the board. He was trading a currency, singular. He didn't identify weakness in the pound US dollar or the pound yen. He saw weakness in the pound as a single standalone currency, and he sold that currency, and of course he made fantastic profits. And that is what professional currency traders do. We look at the individual currencies and we buy the strong ones and we sell the weak ones. I mean, isn't that, one of the basic tenets of successful trading? We buy strength and we sell weakness. Okay, so here is how we do it. Compared to other markets, Forex is huge, and that means we have a lot more information that we can use. The oil market is made up of oil priced in dollars, and therefore the information about the oil market is displayed on that single oil chart. Gold is the same, and all the price information about the gold market is contained on one gold chart. The Forex market, however, is made up of the euro, the pound, the Swiss franc, the yen, the US dollar, the Australian dollar, the Canadian dollar, and the New Zealand dollars, and 28 separate pair combinations. And that's just the majors. So when you look at a single chart, like the euro-US dollar, for example, you're only seeing a tiny fraction of the market, 1/28 of the market to be exact. So the majority of the information pertaining to that chart is actually not in that chart. It's out here in the wider market. Now remember, in the euro-US dollar chart, there are two currencies, the euro and the US dollar. So if you want to be able to trade the euro-US dollar chart effectively for maximum profits with minimal losses, you first of all have to know what's happening with the euro and the US dollar as individual currencies. Now, this is the advantage that we have as Forex traders that other traders simply don't have. If you were a technical trader trading oil, you have a single chart with which to gather information to make your trading decisions. But when I trade a currency pair chart, I've got all this other information to draw on to help me make the best decisions at all times. My trade decisions are much more informed than the average trader. They keep, or the key to maximum profitability in Forex is to analyze individual currency strengths first and foremost, and then match the strongest currency against the weakest currency and select the most appropriate pair to trade based on that information. When you look at the pound dollar chart and it's in a sideways choppy range like this, do you know why? It could be because both the pound and the US dollar are both neutral. Each currency could be flat, equal in value. So when you pair them together, there's no imbalance. And remember, we need that imbalance for a trend to happen. There's no real demand or excess supply of either currency, and therefore there's no movement on that pair chart. Actually, you get the same situation if two currencies were very strong or both very weak. If the euro was a strong currency and so was the Swiss franc, they would cancel each other out when paired with each other because there isn't an imbalance. So you'd still see that flat sideways range on the euro-Swiss pair. There has to be a difference in the individual currency strength or weakness for a pair chart to move. You have to remember that a pair chart is basically just an arbitrage of two different currencies. But what about if the euro was very strong and the yen was very weak? Now you've got a genuine imbalance between the two. The euro is gaining value and the yen is losing value. Now, when you match them against one another in a pair, the euro-yen chart, you've got a huge imbalance and you are going to see a real move on that chart. You've just matched strength against weakness. This is buying strength and selling weakness. So can you see the advantage that I and other professional traders have? And by the way, this is an advantage that you can easily have as well. While the amateurs and say less informed traders are looking at pair charts and really not having a clue what's going on or why, those of us in the know are looking at individual currencies and carefully selecting the ones which are most likely to have strong trends while simultaneously avoiding those which are most likely to be in a sideways range. So think about what this means. If you trade currency pairs like most people do, it is really just blind luck whether you get caught in a sideways range or a trend. You have no way of knowing when either of those market conditions are likely to happen if all you're looking at is a single chart, because you're trading with limited information. You're not taking full advantage of all the information available to you in the Forex market. However, if you look at separate currency strengths, you can quickly spot currencies that are equal and will therefore cancel each other out on a pair, so you can avoid trading those sideways ranging pairs. And at the same time, you can see the strong and weak currencies which are opposite to each other and will have the biggest imbalance, and therefore will be most likely to have strong directional trends on their corresponding pairs. And these are the pairs that will offer the easiest profits. So when you analyze currency strengths, you can avoid ranging markets and generally find the trending market. So do you think you could increase your profitability if you traded in this manner? Well, here's how you can do it for yourself and get your trading off to a flying start in 2013. I've already explained that you need to look at every individual currency and measure how each one performs across the whole market in every pair it is involved in. So to determine the overall strength or weakness of the euro, I'll look at all these pairs. I compare how the euro is performing against all the other currencies in those pairs. So on some, the value of the euro will be going up, and on others, it will be going down. So I calculate those, add them all together, and the value I'm left with is the real value of the euro as a single standalone currency. And then to see what's happening with the US dollar, I look at all these pairs, I check the value or the price of the US dollar in each pair, then I add them all together, and the total number I'm left with is the true value of the US dollar as a single currency. And I do this for all the major currencies. I'm then left with the true value of each of the major currencies. And once I have that information, I can compare each of them against one another. I can see how they're performing relative to each other. And when I do that, I can see which currencies are strong, which are weak, and which are neutral. I can see where the imbalances are, and therefore where the trends are likely to be. Now, I'm clearly not making all of those calculations myself manually. I need that information instantly in real time and constantly updated so that I can see the changes in strengths and weaknesses as the prices change up and down. So I use an indicator. And you may well have seen this kind of thing before. There are numerous different tools around on the internet that measure currency strength. Some are available for free on various forums, some of them you have to pay for, but they all attempt to measure the same kind of thing. You've basically got a display of coloured lines, where each of the lines represent a different currency. And the idea, in its simplest form, is to identify the strongest currency and match it against the weakest currency, and then trade the corresponding pair in the appropriate direction. If you can do that, you will put the odds significantly in your favour that the pair that you've chosen will continue moving in the same direction, and you will take a profit from the move. And I can assure you that no matter what system you currently use, as soon as you start taking strength and weakness into account, your system will increase in profitability. This is a real edge that is actually based on reality, something that matters in the Forex market. Now, of course, the different strength indicators available online are of different quality and reliability. The basic free ones that you can find in the forums that plug in as simple MT4 indicators are a great starting point to get you going in the right direction, and you can start experimenting with them today. So this is something you can use in your trading right now. If this is the first time you're looking at strength and weakness, they're a great way of getting your feet wet and pointing you in the right direction. But as you'd expect from a free indicator that plugs into MT4, they're fairly basic and limited. And I wouldn't risk substantial money on the information that they give you, but they are a good starting point. I use something a little bit more advanced and professional because I am after the reliability and the robustness and maximum profits. So this is the currency strength dashboard that I use. It was designed to mimic the information and analysis that my bank trading mentor showed me that her trading desks use. Now, obviously, this isn't the same tool that her bank was using, but it is monitoring the same multiple conditions. I'll quickly explain what the software monitors and then how I use it to determine trade entries, and then I'll show you an example of a trade, the way I trade it. Now, I monitor currency strengths on 3 different time frames. So this left-hand box is the session. So I can see how each currency is performing in terms of strength or weakness for a particular market session, like the London or the New York market. That helps me trade in the same direction as the institutional traders for that particular period. The middle box is my medium-term time frame, and the right-hand box monitors the very short-term time frame for me. So for my trading, I have this set to the open of each market session, so 0800 in the morning for that particular market. This measures the last 1 hour, and this measures the last 10 minutes. But of course, I can change these times and settings to anything I like, all the way up to the monthly charts. Obviously, the currencies in the top half are strong, and those in the bottom half are weak. Above the strengths, I monitor the pips and the ticks, so I can see when there's an increase in pip ranges on price bars compared to certain averages, and then the same is true over here, but this side measures ticks instead of pips. So I can see when there is increased order activity on a currency from the ticks and greater price movement and volatility from the pips. So all in all, I'm measuring strength, weakness, momentum, price changes, and the order activity. Now, the top table up here collates all that information for me, and it displays in a handy color-coded format so that I can get an instant overview of each currency at a glance in one easy snapshot. The more green the currency means there's more strength, and the more red means more weakness. And then finally over here are little confirmation signals to tell me when certain favorable conditions are present on specific pairs. So it shows me possible buy or sell trades, red for sell and green for buy. So when I trade based on all this information, my decisions are much more informed and I'm much more profitable. Looking for this information means I always buy strength and sell weakness. And when I do that, I've got the greatest imbalance between supply and demand. And that imbalance is what causes the intraday trends. Prices are statistically more likely to move in the direction of the imbalance. That is a real edge. So once I've identified that imbalance by looking at the currency strengths, I then just open up a pair chart and I enter my trade. I'm not waiting for candles to close or lines to cross this, that, or the other. I'm trading on strength, pure and simple. So I'll open the trade when the strength is there, nothing to do with chart analysis. Once the trade is open, this indicator then tells me where my stop should be moved to, and I trail it up behind the price as the trends develop. So I don't have profit targets. I simply allow the trading stop to keep me in the trade for as long as the trend continues. And I close out when that imbalance that I've just exploited changes and the price reverses. Now, there are a few factors which make this entire approach phenomenally profitable. First of all, by trading only strong currencies against weak currencies, you are always trading where there is an imbalance between supply and demand. And statistically, price is more likely to move in the direction of that imbalance. That means you're right more than you're wrong, and you win more often than you lose. Secondly, when that imbalance exists, because of the way momentum feeds on itself in terms of liquidity consumption, the price is more likely to continue to move further and longer in the same direction, which means your average win is larger than the size of your average loss. And then finally, the icing on the cake to really top this off is the fact that we can also identify currencies which are neutral or equal, which would cancel each other out. And so we avoid those horrible sideways ranging pairs. And therefore, we limit the number of unnecessary losing trades. Those things combined, having more wins than losses and your average win being larger than your average loss, gives you what I would consider as close to a holy grail trading strategy as it is really possible to get in Forex. You'd be happy to exploit that kind of edge, wouldn't you? Well, all in all, this is just a fantastic way to approach Forex. No matter what strategy you currently use, currency strength analysis should play a part in it. If you're not incorporating strength and weakness in your Forex trading, you are missing out on perhaps the biggest advantage, that biggest edge available to you as a currency trader. So take advantage of it, exploit it, use it to make you more profitable. Now, that is, looking at the time, and me just about out of time for today, but I hope that's given you a bit of an insight into how to use currency strength analysis in your trading to identify strength and weakness and find the currency pairs which are statistically more likely to move in one direction rather than the other. If you would like to find out more and get more free training on the topic, then please feel free to visit my site at completecurrencytrader.com, and I will be happy to help you. But for now, that is me done with the presentation.
Right,
thank you very much for your time. I hope you enjoyed that, and I hope you enjoyed.
Thank you, James. That was an excellent job, and we appreciate you taking the time to be here for sure. And again, if you get a chance, please type in your contact information in the chat area where people can follow up with you. All right, at this time we should. I'm going to turn things over to Colin. Colin's going to talk to you guys about a couple of different strategies with binary options. So Colin, you can go ahead and come on and take things away.